Welcome to another episode of the Financial Armor Show. My name is Jose Rodriguez, investment advisor here at Cooper Financial, and your host for today, alongside my co-host, Tony Shore. How's it going, Tony?
Oh, I tell you what, Jose, I'm so excited about the show today. We were talking a little bit before the show. We've got a very special guest that you're
Yep.
bringing on, a huge get for the show. I don't
Yeah.
know how you do it, Jose. But yeah, I've had a great week. My daughter graduated from college a week ago. Very proud of her. Magna cum laude, whatever that is, 3.9 or whatever. She did great. And so we're proud of her. She's already got a job lined up. She works for Clifton Allen Larson or one of these big accounting firms. She's doing nonprofit audits of
Okay.
nonprofits, mainly
Very
schools.
interesting.
So
Very nice.
yeah. So we're proud of her. Got a full-time job lined up. That's great. How about you, Jose? What have you been up to?
I've been great. I'm enjoying and taking advantage of the slower times now, the post-tax season.
Sure.
And I do have a trip coming up with my mom. I'm taking her to Spain as
Wow,
a
that's
retirement present to her it's been long overdue. But that's going to happen sometime. I leave on July 20th and I come back August 1st. I think that's the dates. So just planning everything. The tickets are bought, but I haven't planned what we're going to do from the time that we get there to the time we leave. So it's kind of, trying to balance, exploring and the adventure part of traveling with the scheduling, making sure that everything happens on time. But with traveling, Professor Hill, he just got back from a honeymoon, right? Congratulations on getting married, by the way.
Thank you very much. We actually were going to go to Spain originally, so I'm curious to know where you're going.
We're going to Malaga.
Oh, okay, great. That's exciting. We were going to kind of do like maybe the southeast coast of Spain, and then we ended up going to southern Italy and Paris instead. So
nice,
still nice.
You really can't go wrong with a honeymoon in Paris. I mean,
nope.
No woman is saying, "Oh, I don't want that."
So we've got to introduce our guest, though, to our audience. Yes. Alex Hill. Tell us, you introduce him, Jose. You know Alex, and you're bringing him onto the show. Tell us about Alex, and then we'll have him tell us about himself too.
Yes. So let me tell you just his background. He earned his bachelor's degree in economics from Claremont McKenna College, and later completed his PhD in economics at the University of Colorado in 2017. And he current research explores the intersection between industrial organization and environmental economics, which is really interesting, especially in today's climate, I feel like. But more on how he's connected to me. He was my former professor, which it seemed like I couldn't escape him. He was my professor everywhere. He was the main professor sometimes, or he was the assistant professor sometimes. And essentially the majority of the classes that he was involved in and lecturing and teaching me economics had to be economic theory, regression analysis, and industrial organization. And essentially, to put everything in simple terms, he taught me economics, not with words and sentences, but with just hieroglyphics, math stuff, and things that made me lose sleep at night. And so all these things right here you see under my eye are because of him.
I think that's good.
Hey, but I'm here. I made it. I'm alive. I got my degree. But yeah, Professor, I really appreciate you being here, and thank you so much for coming on.
No problem. I'm excited to be here. I spend a lot of time, as a teacher, just kind of trying to talk about some of the issues that are going on in the world in a really approachable way. So that's my goal for today for you guys, is just to make it as easy and simple as we can here.
Yes. So let's just jump right in. One of the things that I want to talk about is something that's just started happening. The one big beautiful bill just passed the House of Representatives. That's the name of it. How it passes the House of Representatives, and now it's on its way to the Senate. And it has a lot of big things that we'll cover in a different time. Once it gets solidified, once it passes the Senate, and it passes the presidency. But just big, high level. Essentially, it extends the 2017 tax cuts and attempts to make them permanent, and reduces spending on some social programs, increases funding for border security, boosts defense spending. And I was reading up on it, and according to The Guardian, this bill is projected to increase the deficit $3.4 trillion by 2034. Now, Professor, based on your analysis on this bill, how accurate or reasonable are these projections from The Guardian?
Yeah, so the first thing I would say, and just kind of as a precursor, is that academic economists, we are economists first, and then we have kind of political leaders second. So we choose our political party based on our economics and what we believe about economics. So, and I mention that just because in today's world, it's always like, oh, well,
right.
what's the spin that this person's
Mhm.
trying to put on something? And my spin is just economic sense. That's what I care about. So that's how we're going to approach this bill. And rather than getting into the, Democrats say this, Republicans say this kind of stuff. That's politics. I have no expertise in that, but I can talk economics. So with that out of the way, we are here because of 2017. That they basically had rules, and some people may know this, some may not, in the Senate, that you could not pass that bill without getting the 10-year deficit below $1.5 trillion. So that's about $150 billion a year. So, but what they wanted to do was going to cost more than that. So what they did was they pushed it all into 8 years, the good stuff. And then all of the stuff gets reversed in the last 2 years. So sometimes you hear the sunsetting of the tax cuts. So they did that partly because they knew that no Congress is going to come in 2025 and say, well, now we're going to just have huge tax increases.
Right.
So we are doing this now because of that. So it's important for everyone to kind of have that as their initial mindset. So there's a bunch of different things. You said it's a big, beautiful bill. Congress always has little acronyms for all kinds of stuff. Like we might remember a few years ago, the Inflation Reduction Act. That really had nothing to do with reducing inflation.
Right.
It was an energy and environmental bill. It was my kind of bill.
Exactly.
So anyway, it's got a lot of things. The most important things that stand out, of course, is the headline number that you talked about. The Guardian reporting $3.4 trillion. They're reporting what is coming out of one of two places: the Congressional Budget Office or the Joint Committee on Taxation, the CBO and the JCT. These are nonpartisan organizations that what we call score these bills. They look and they say, okay, well, what do we think revenue is going to be after this? What do we think spending is going to be? And what's the difference? So that 3.4, that's where that's coming from. The Guardian isn't doing their own math on that. They're just citing, they're citing one of those. So what the real question is then is that it's not really, do you trust the Guardian or not? Do you trust the CBO? Do you trust the Joint Committee on Taxation, the JCT? And by the way, that 3.4, they just updated the numbers on that, the Joint Committee on Taxation, because now there's a new deal. You know how all this stuff works.
Yeah.
And because now they've raised the tax deduction for state and local taxes. That was one of those big reasons for this bill was when you're itemizing, so you're not taking the standard deduction as a taxpayer, you're itemizing how many of your state and local taxes can you deduct from that. And if you're in California, you're in New York, that's pretty important. There's some state taxes that if you've got a decent amount of money, you want to deduct those. So they got to get the votes, and that's where that thing is headed. So big things about this bill. It's going to run up the deficit. It tries to compensate for some of that stuff with cutting Medicaid, and I'll talk about the reason why in just a second. And then it's this question of the state and local tax deductions and where those end up, because the bigger that you make those, the more money you have to borrow. So, but if you don't make them big enough, you don't get the votes. So there's kind of a toy there on that. Now, the Medicaid part, and this is the last thing I'll add about this. The federal government, I know that we all kind of have this idea. We hear, oh, there's waste and whatever. Most of what they do is they kind of take money and they shuffle it to somebody. So they do this with Medicare. They do it with Social Security. They do it with Medicaid. There are 5 big parts of the budget that are over 80% of the budget. They are the interest that you pay. You can't do anything about that. You could default. That's not that's in nobody's scorecard. So you can't touch that. Defense spending, that seems to be rising over time, not falling. There's a whole, politically, it's generally considered that you can't touch the defense spending. Social Security and Medicare, those are the two of the other parts. These are programs that primarily go to older Americans. Older Americans vote a lot. They rely on these things. A lot of Americans, this is their sole income or the majority of their income. That's dangerous to touch those. And then Medicaid is the fifth one.
Right.
And if you don't want to do one of those five, there's not enough to cut. So if you're going to try to afford these tax cuts and the state and local tax deduction, you kind of have to go after Medicaid. You have to do that, and how they're doing that, we can get into that later if you want to. But that's why we are where we are. It's no mystery that we got here. If you want to cut taxes, it's going to be very hard to find enough spending cuts to reduce it. So you're going to have to run up the deficit. And so is it going to be the 3.4 trillion that was originally announced, or the more recent number that was 3.8 trillion? It kind of depends on where the final bill lands. And it also depends on how fast the economy grows. So the Joint Committee on Taxation and the CBO, they make projections of what growth's going to be. They don't have a crystal ball. They do the best they can. But, there are recessions, and then there are recoveries, and there's new technologies. How is AI going to impact this stuff?
Right.
All those things we're asking. So, they project things out, and we could end up a little higher or a little lower. But in no way are we going to not have a deficit from this if it passes.
It's just how big.
Just how big.
Right. And that's one of the things that throughout my college career and learning about how economics works is that sometimes these models that, like, for example, CBO uses, sometimes don't account for efficiency. There's that's accounting for efficiency is hard to calculate. So how AI would play into that efficiency and the growth, and to change the rate of growth, like you say,
or lack thereof, or lack of efficiency.
Exactly.
And let me just say real quick, let's put that in kind of real simple terms, that our growth is the result of two things: how many people we have and how efficient they are at working, meaning how productive they are. So you're talking about the productive part. And if that is higher, we grow faster. And if it's lower, we grow slower.
There you go. But now going on to adding to the deficit and what it currently is, that interest rate on that debt right now accounts for, by the way, it says 36.7 trillion as of when I forget when I checked this, but it probably is the same thing right now. And the interest on that in 2024, it was $890 billion, which was 13% of the federal budget. And that is gradually, exponentially growing, actually, right? And is this trend sustainable? From our perspective, they're going to kick this can down the road. They're going to keep running up the deficit. And then, my generation is going to eventually pay up later for the consequences, right? So how sustainable is this running up the deficit in the upcoming years?
Yeah. So I don't know if you were able to put up one of the graphics that I sent, the first slide. That this is what I want. So this is the CBO's projection, the latest projection that they have on, and notice it goes back in time to give you kind of some perspective of how much you bring in, that's the blue line, versus how much you spend. So of course the gap is going to be the annual deficit. And when you add those up, you get the debt. So what I like about this graphic is it shows you two things. First of all, it shows you over time, there's a widening gap between those two. So the orange line is going up, the blue line may be slightly going up, but not much. And so the difference is going to be a higher and higher deficit, which leads people to think, well, how long can you really go on with that? The second thing to note is that we are kind of about at the same revenue as a percent of GDP as we always have it. Now, real quick, let me say why I have this as a percent of GDP. Everything about the U.S. is big. We have a big population. We have a big GDP. We have a big debt. And when you're thinking about, well, what does that number mean? When you say $36 trillion of debt, that seems like an unbelievable amount of money. So how much really is that? How do we think about that? Well, you think of it in the same way that a household would think about their debts. Well, how much income do I have? So let's say you borrowed money to buy a car, and it's a $20,000 loan, and you're repaying that back. Well, if you're a household that makes $200,000 a year, you're going to be able to pay that back. It's not going to be crippling. But imagine you're a household that makes $40,000 a year. Well, all of a sudden that's a really high debt. That's going to be very hard to get out of. So notice that what your income is, that's how you measure, well, how crippling is this debt? So in the same way, we do the same thing. We say, well, what is our debt as a percent of GDP? What are our spending, our outlays, or our revenues as a percent of GDP? It's a way of level setting for the size of our economy. So that's why that's there. So my point is that if you look at the blue line over time, you took an average of that, I don't know, our future looks kind of like whatever the average has been. So in other words, it's not like we're collecting a lot less revenue than typical. It's the rising expenditures. Mm-hmm. What is that? That is two things. You could add a third if you want. Higher interest and the aging of the population. So as the population is getting older, we have more older people. The baby boom generation was a little larger as a share than other generations have been. We have to pay the benefits to those people. They paid into the system, and now they want their benefits, of course. And that costs more and more money over time. If you also wanted to add in a third factor of our healthcare costs, I think we'll get into that in a little bit later on. But that's a third factor that's pushing this up. And so if we want to reduce this thing, if we want to say, okay, we want these lines to meet, well, you kind of either have to do one of two things. You have to raise the blue line above where it has been historically. So taxes on average have to go up. Now, that doesn't mean they go up for everybody. It depends on who you tax, but that will have to go up. So you could do that and cut spending, or just cut spending. But notice that if you are cutting spending back down to the blue line, you are saying that we're going to have the same level of spending as we did in the 90s or the 60s. You can see that's when that line was right around there. And that's not very realistic when you think about we have many more retirees today. The things that government does tends to be a little more expensive over time. Goods tend to get cheaper over time. The government doesn't buy a lot of goods. They provide services. Services are more expensive over time because people are expensive. So you could say, oh, well, let's just reduce the spending back down to the blue line. Well, that's going to be what you're going to do is cut a lot of benefits for people. And you could choose to do that, but that's the math of it. You can't get around that. So is this sustainable? One way to look at that is just to look at, well, what has happened to other countries over time when they have had debt of ours as a percent of GDP? How have they managed it? And there's a general rule that if you borrow the money in your own currency, so like the US does, or Japan does, or the UK does, that you don't tend to face a problem, that markets tend to give you a lot of leeway to gather debt because your debts are in a currency that you print. So if you really had to, you can come up with the money versus we might not remember, this was a long, 15 years ago, but the euro area, the countries that use the euro as a common currency, and they have the central bank of Europe, the European Central Bank is their central bank. They ran into a big problem with their deficits. And the reason why was they don't print their money. The European Central Bank prints euros. Spain doesn't print euros. Italy doesn't print euros.
Well, isn't that what happened to Greece?
Greece
yes,
doesn't print euros. Yeah.
Greece lost the drachma. They didn't have the drachma anymore. They had euros. Well, they don't print euros. So they ran into a problem. So you might look at this, and if you were kind of an optimist, you'd say, we print our money and we'll figure it out. And, we've been here before. During World War II, right after World War II, we had high debt and we got out of that. Like, it's going to be okay. That's a reasonable thing to say. But then there's this other aspect, which is that over time, there's been this assumption that the U.S. is going to play by the rules. And eventually we're going to kind of get our financial house in order, and we're a responsible country. And when countries signal that all of a sudden they're doing things that are not responsible, that are very wacky, that are for no reason racking up debt, investors go, oh, I don't know about that. I don't know what's going on here. This very thing happened to the UK almost 3 years ago. There was a very short-lived prime minister there who and she had a little budget that was the markets thought was kind of really wacky, and there was a run on the pound. And this the UK borrows in their own currency, so they're kind of like the US. And it was kind of a warning that, hey, if you do have a bit of a high debt and then you do some wacky things, investors may not necessarily go along with that. So you could say that with a country that already has our debt level, and we're saying over the next 10 years, because remember, this graph does not have these tax cuts in it. So we are already facing this. So what we're saying is we're going to add the extra part on.
Yeah, it's going to make it.
Could investors look at that and go, what's going on? Yeah, well, this is not normal here. We're starting to get a little bit worried. There's a country that already has a problem and they're adding on to it. So, the easy answer would have been to say, who knows? We're going to find out.
Yeah.
But I think those are the things that you want to think about when you're trying to guess at this.
Right. And from what I got from what you said was that the likelihood of them decreasing their outlays or spending, the likelihood of that happening is way less than them increasing the revenue, right? So, right?
Yes. And it's not one of these situations of, oh, well, Washington, D.C., they like their spending. It's that at some level, if you're going to make serious cuts to the deficit, that you're going to either need to take away benefits from elderly people in the form of Social Security and Medicare, that, again, over half of Social Security recipients, it is their primary or only source of income. So that's tough. I mean, that's not just tough politically, that's tough ethically.
Right.
or you really have to go after Medicaid a lot. And that's kind of where we are. And we're not canceling Medicaid, but it looks like we're going to take a chunk out of it to help pay for this.
Right. And I just want to kind of add a little information there for just so our listeners know what is the most the largest source of revenue for the federal government. Just as the
government gets 90% of its money, just about 88%, from two taxes: income taxes, federal income taxes, and payroll taxes. Or sometimes we're called the FICA taxes. That's the taxes that were put in to pay for Social Security and Medicare.
Okay.
They're roughly equal. The income tax is a little more, but they're both very large.
Right. And so that begs the question, back, and you brought this up, back to this debt to GDP ratio we haven't seen since post World War II. Right.
And I've got a graphic. If you want to go to the next graphic,
have that?
you can see that's
there we go.
Here's where we are.
So, and I wish I don't think Tony, you have this, and I should have brought it. But this is something our clients see all the time: is the history of taxes. The highest, or if you look at post World War II, I think the highest tax bracket for the highest income earner was 70%.
91%.
91%. There you go.
Even 91. Worse. Yeah.
So and that's not even counting state taxes. All right. Thankfully, here in Arizona, we're good, but everywhere else, kind of screwed. But the point is, what is stopping the government just from going back to what they did back in the late 40s to fix this debt issue? What's stopping the government from going back to those tax rates?
I looked this up. There is a big difference between the top marginal tax rate, which is what the wealthiest people pay, and what the average tax rate is. And there's even a difference between the top tax rate, which is kind of a hypothetical thing, and what it is after all the deductions that you take. And so it turns out that when you look at what the average taxes paid in the U.S. were in the 1950s and 60s, they're very similar to today. Ours are maybe slightly higher, but only by a few tenths. Now, they were different at that time. We pay more payroll taxes now. We pay less corporate income tax as a share of income. We pay slightly less in duties and things, although we've got tariffs now, and so that's a whole separate thing. And the shape of the income tax thing is very different. What we did is in two steps in the 60s and in the early 80s, we dropped the marginal tax rate on the top down. We restructured our brackets, and that top rate went from 91 down to 70. It briefly went down to 25, and then the Reagan administration went, "Whoa, these deficits are getting a little large," and they brought that back up again. And then we toyed around with it, and the Clinton administration raised it, and then the Bush administration dropped it, and then the Obama administration raised it, and now Trump did. So it's gone between 39 and 37. So it's in the high 30s. But of course, that's on your last chunk of income above, I think it's something like $600,000. So your first $600,000, you pay lower tax rates, and then anything above 600,000 you pay above that. But that's of course net of deductions. And the reason why those 91% tax rates in the 50s and 60s and getting into the 60s they weren't collecting a lot of revenue, because the books were filled with ways that you could deduct money. So if you were putting money here, there, whatever, you did not have to pay any income tax on those. So marginal rates, that the average rate that the rich paid in the US in the 50s was not very high. It is actually higher today, even though our top rate seems like it's much lower. So that's just kind of a primer on marginal tax rates. And so then your question, right, was kind of like, where do we see this going? Where could we, maybe you could ask, where could we go for revenue?
Right.
And there have been some things published that some ideas that might be a little more amenable, instead of just raising tax rates way up, or introducing a value-added tax or a national sales tax. Those are kind of the same thing. That's what Europe does. That's what Japan has. A lot of countries have that. And so some of these are, first of all, you could collect the taxes that you owe on the books. So estimates vary of this, but there's something like an $800 billion gap between what we should be collecting each year in taxes and what we actually are.
Wow.
And yes, it's massive. And the reason for that gap is the reason why we added more IRS funding in that bill a few years ago, is that the IRS has had its budget cut over time. And what is that? What do they have to cut? Well, they have to cut people whose job it is to investigate tax fraud. And so we don't know what that exact number is, but we kind of have a good estimates of it. And there's some sources here that I can give for that later if you'd like. But so that's one way in which you could all of a sudden get a big chunk of money back, is just collecting taxes that should be collected based on the laws that are on the books. Now, that does mean the taxes will go up for those people who aren't paying that,
Right.
but it's not any new taxes. Right. So, so I think that's something that, could be worthwhile. Something like $600 to $800 billion there. The second one, we do this weird thing. We started this program in the late 90s called Medicare Advantage. And some people are on that plan. It's basically Medicare, but it's financed and it's operated through private health insurance companies. It's very inefficient. And there are some estimates that somewhere between $130 to $200 billion a year is charged to the government, in excess of what Medicare would have charged if it was operating these plans directly. What are these private insurers doing? They're skimming off the top. They're charging for certain services and not many payments. So so that's the estimate. So right there, we're talking about somewhere between $700 to $900 billion that you can just collect from doing things that don't raise any tax rates at all. And then a third thing, if you want to throw in more that maybe people wouldn't feel very much, is corporate taxes are very low in the United States. Our corporate tax rate that people paid, that was what was on the books, the statutory rate used to be very high. We lowered it in the 2017 bill, but very few people paid that. And U.S. corporations, just like corporations around the world, have gotten very good at putting money in places where it's not taxed very much.
Right.
So for some reason, the U.S. has huge operations. U.S. companies have huge operations in Ireland, but they don't have very many employees.
Hmm.
So it's a very strange thing. And so there are different estimates of how much you could cut, you could get back based off of this if you tax people corporations what they should be paying instead of these gimmicks of reporting income in other countries. That's stuff that's really produced here. But something like $80 billion, $100 billion possibly a year is going that direction. So you add up these things, and you're talking about if our deficit's around 1.7 trillion right now, you could add these up and it's almost $1 trillion just off of, what we should be taxing that's on the books, but that isn't.
$1 trillion. And that's real money. That's real money even to you, Jose. That's real money.
So those are some ideas where you could go. You could also then let the 2017 tax cuts expire instead of extending them in this bill and go back to where we were in 2017. And you could do some other things like that. But those would be pretty simple things to do that you're not like implementing broad new taxes or significantly increasing income taxes.
Or cutting social services that people rely on.
Or cutting social services, yes.
Right.
And then the final thing that I'll add, if you want to go to the next slide here, there is something very encouraging going on, which is one of the problems in that deficit that I showed you, where the orange line is outpacing the green line or the blue line over time, our expenditures are rising, is that we have the highest healthcare costs in the world in the United States. We pay a lot for healthcare. And there's a lot of different reasons why that is. But that's been slowing. So what I'm showing you here on this is from 1970 to 2007, there was this general trend in health expenditures that if it continued, would be the blue line. So this is, dollars per person. Well, all of a sudden, kind of in the early 2010s, this thing flattened out a little bit. It's grown, but it's really growing a lot slower. Now, you could look at that and say, well, yeah, at a certain point, like you can't spend what you don't have. And we were spending a lot of healthcare. And then people said, hey, I can't spend that anymore. Or we've made some little changes that have helped slow the growth of this thing. And that's huge because remember, the government is paying for Medicare and Medicaid. So taxpayers on the hook for both those. Those are heavily influenced by this curve. And so you might ask yourself, well, is that impacting Medicare? If you go to my final slide that I've got, you'll see that the answer is, and I don't want to give it away, yes, it is, that Medicare costs have also slowed down. And that has helped projections in the future. We still got problems. But I mean, when you were looking at the budget problems in the 2000s, projecting forward, you were going, oh my gosh, like we're in big trouble because of this. So the fact that that's slowing is huge. And it means that we don't have to make the really hard choices that we might have to of paying a lot more in taxes or of cutting Social Security for people that really need the checks. This is just, hey, we're not paying so much for Medicare and Medicaid, still providing services to all these people. And so it's almost like a free lunch, even though economists don't believe in those.
Yeah. There's no such thing as a free lunch.
No, yes. Yeah, and we could talk about this for hours. I have so many what if this, but only one I'll bring up because it was also part of the CBO. And I know we're running out of time, so I'll be quick. It was part of the CBO report of the ratio of people paying taxes to retirees. And I think that ratio would just dramatically decrease by 2033, I think it was. Do you know which report I'm talking about?
So yes, and I love that you brought this up because I'm actually fascinated by this. I'm writing a paper right now about declining ratios. We call these dependency ratios of how many taxpayers do you have per dependent, right. And that's going to say how much in taxes you're going to have to pay. Because if you have fewer taxpayers, you got to cover more people.
Exactly.
And when we created a lot of these programs, we had 8, 10, 11 taxpayers per beneficiary. Right. Remember, when Social Security is created, the average age of death is 67 in the United States. And now the average age is almost 80. So people are collecting for a lot longer. There's been a slowdown in population growth. So I'm fascinated with this kind of stuff. And hey, we got it a little bad, Europe's got it a lot worse.
Yeah.
Look at China. In about 15 years, it's catastrophic because, of course, they had their one-child policy where they have all these people that are now retiring who were born before 1972 or whatever it was, and now they want benefits. But since 1972, birth rates dropped off, and you don't have the same number of taxpayers. So they got all these people who want benefits, not as many taxpayers. We got problems. They got real problems. But yes, that is part of
problem.
If you want to keep benefits the same for everybody, so you don't want to cut the benefits per person, and you don't want to run up deficits, you're going to have to raise taxes. It's just that you have to choose one of these things. You can't just opt out of it.
And we've seen, being in this business now for quite some time, I've seen so many different ways a person retiree can get taxed, even all the way from Irma, which we've talked about on the show. And I bring up Irma to my clients all the time, is the surcharge on Medicare. And it's all depending on income that they receive. And they can leave that for a different show, for a different episode. But we're running out of time. Professor Hill, I really appreciate you coming on the show. And I hope in the future we get to get back together and then talk about some other fun things.
There's always going to be new stuff. And I think you got to congratulate me. I'm an econ professor that only showed 4 graphs. You didn't see 10 or 12, and there's no Greek symbols. So I think I did great.
I was worried when I saw you sent over a PowerPoint. I'm like, oh, an econ professor sent a PowerPoint. I wonder how long it'll take to download, how many slides there are. I don't know if I can fit that on our servers here.
Yeah.
But it was more graphs than Professor Tang had for us.
Okay, well, so I'll gloat when I'm in the office next time.
Yeah.
No, tell her we said hi. We miss her already, and I appreciate you coming on the show, Tony. If there's anything else you want to add.
No, but before we go, really quick, please, Jose, let our listeners know if they have questions about their retirement plans or are worried about their benefits in retirement. How can they get a hold of you to set up a solid retirement income plan?
Yes. So if somebody has some questions and how this whole conversation affects them and their particular financial situation, please give us a call at 888-390-5277, and then we can have a chat, no obligation chat, and then we can talk about how these risks affect you specifically.
All right. Great show today, guys. Professor Alex Hill, so great to meet you. And wow, a lot of great information today. Fascinating stuff. Listeners, again, that number 888-390-5277. If you have questions, ask for Jose. And that does it for today's episode of the Financial Armor Show with our host, Jose Rodriguez.